Good afternoon, everyone. Mark Rogerson here. Hopefully you can hear me okay. We're going to be running this in a couple of minutes. We're just waiting for a few more people to hop on. Just a few more minutes and we'll be with you soon. Thank you. Hi, everyone. Thank you. Thanks for joining our first webinar since for quite a while, since our COVID times. We webinared quite a bit during COVID with JobKeeper and all sorts of things. So this has been some time coming, and these changes to super are fairly important. So we thought we'd do a webinar on this. So those that haven't met me before, my name's Mark Rogerson. I'm Managing Director at Rogerson County Business Accountants, and this is actually a big year for us. We're celebrating 50 years in business, which is something we're very proud of. And over the time, we've worked very closely with business owners and SMSF trustees and investors, helping navigate compliance and also the bigger picture around around strategy and structuring and tax and long-term wealth creation. A big part of what we're seeing at the moment is increasing complexity around the tax landscape, particularly with super. And this topic's a really good example of that. So this new Division 296 tax, or what's being commonly referred to as the $3 million super tax, is one of the most significant changes that we've seen in recent years. And as always with tax, the detail really matters. So the purpose of today's session is to break it down in plain English, explain what the rules are, who it impacts, and importantly, what you should be thinking about from here on in. Before we get started, a couple of housekeeping items. We're on Microsoft Teams. You'll see, and I believe everyone's screen's the same, you'll see the top panel, there's a chat and a Q&A function. Encourage you to use the chat function if you're having any technical difficulties, and to use the Q&A function for just that when you've got a question. As you can imagine with the webinar, I think we've got 20 odd slides. We do cover most questions you may have, but please, if there's a question, put it in there. If it can be answered on the spot, we'll do that, or I might put an answer into the question in the chat. But certainly either by the end of the session or offline, we'll certainly cover all of those questions that you may have. Further, today's session's being recorded, so we'll happily make the recordings available to anyone that wants them. And of course, we can obviously discuss the situation one-on-one. And I guess the purpose of today isn't to be providing personalised advice. It's more to give an overview of how it works, like I said, and who it impacts. So I'll be hosting today, but I'd like to introduce Sarah Davey. So Sarah's an Associate Director here at Rogerson County, and she heads up our SMSF division and one of our key specialists when it comes to superannuation. She works closely with our SMSF clients on a day-to-day basis. Most of you would or should know Sarah, and you're quite excited with this presentation, how it's come together. So Sarah's got a deep understanding of the new legislation, and importantly, I think we'll have a good way of communicating that. So with that, I'll hand it over to you, Sarah, to run through the Division 296 tax.
Thanks, Mark. Welcome, everyone. Well, here we are. It's been a bit of a journey since the initial suggestion that they were going to bring in a new tax rate for people who have high balances. So 2013 was when we first got wind of this bit of legislation. And what we actually saw was not quite what we would have expected to see. So this is really today's seminar is really to go through what the legislation ended up looking like and sort of dispel some of the I guess, concerns which are still out there at the moment. So I guess we'll start with what is the Div 296 tax? Well, it's basically a tax, an additional tax on people who have high super balances. So the high super balance, as according to the government, is $3 million. And this is basically looking at all your super interests. But they've also given us a new Div 296, and that's super high balances. So this is for members who are over $10 million will see an additional 25% tax on their earnings. So this legislation passed, I think, about 13th of March when royal assent was given. So it's very fresh. And it is to apply from 1st July 2026. So that means we'll be seeing the first assessments in the 27 financial year. We'll go through in more detail everything, but it is different in that it is levied against the individual, not the super fund. So we'll go through how we can finance paying that tax, where we'll be going for it. At this stage, it only affects a small group of people. So the initial release of this was that not a lot of people will be affected. But what we're finding with how the legislation was written and with compulsory super increasing to what it's at, more people over time are going to be affected. So let's go what changed. What are the horrors that came out of it, and what are probably some things that, didn't win so much in its final legislation? So the key thing is it is no longer based on balance movements. And I think this was probably the best logic to have come out with this new legislation. We're going back to that traditional income tax calculation for this new tax. So we no longer will have that unrealised gain looking at the balance opening and closure and the unrealised movements having tax assessed on them. It was complex, and it really did cause a great unease in the whole super industry. What did come out in this legislation, which I thought was pleasing, so when they first announced that they were no longer going to do tax on the unrealised moving, is there is now this one-off opportunity to reset the cost base. So this is really good for assets that have been held long-term, have significant capital gains. That is going to be grandfather if an election is made. So you won't be paying Div 296 on the growth up until 30 June 26. We're now looking at two caps, as I first mentioned, but what did also come out is they're now going to index. So they weren't going to index the $3 million cap. That now is being indexed. They're doing it in two lots. For the $3 million cap, it's at $150,000 increments. So we're going to see more and more cap indexation on super, anything to do with super. We get them every year. What changes? And the $10 million cap will go at $500,000 increments. This actually means that they could move in different years as time goes on. And the Div 296 now does apply to the member in the year of their death, and that's going to their estate. So that's probably a key change that wasn't so great in the revised legislation. So I guess the first one, which was the most controversial, is understanding what is earnings for Div 296. So the Div 296 is basically your taxable earnings. And that includes your interest, your rent, it's all your passive earnings within the fund and the realised capital gains. And what's really important is that it still gets that discounting that the super fund gets. So we get a 1/3 discount for gains on assets that have been held for longer than 12 months. That still applies. So it's a net capital gain in this instance that will go into the earnings for Div 296. There are adjustments made. So you don't get that exempt pension income. So anyone who's in pension phase, and we get a deduction for the share of earnings that support a pension, they're added back. But contributions, so your contributions aren't taxed again. It was recognised contributions are taxed enough, so we're not going to be taxing them again. The income is attributable to each member. So at the moment, we'll have a self-managed super fund. Everything's pooled. and we pay tax on them. The share of earnings is apportioned to each member. They're now going to be attributing via an actuary to determine what is actually the income for Div 296 purposes. So who's impacted? I guess the big one, obviously, people who have super interests that are greater than $3 million. So it is at the individual level. So you can't be sheltering super between different funds. It's the combination of all your super interests. For clients who have interests in, people who have interests in defined benefit funds, they are going to also be included in this. So we've just got to see what your total super balance is at the end of each year to make sure whether or not you are affected. And how it is now going to work, it's actually going to be based on the highest balance at the start of the year and at the end of the year. So if you have a high balance at 1 July and then you take all this money out, at 30 June, your balance is lower. It will be based on the higher balance, so being the 1st July. The good news is that there is a 12-month introduction to that. So the first year of implementation, being 30 June 2027, that is when it will only be based on the year-end balance. So if you are over and you're looking at strategies to get out of it, or you're looking at strategies to get your balance at a more reasonable level, we do have until 30 June 27 to work on that. So there's still time to plan. That's the key thing. So how this tax applies is proportionally. I liken it to a marginal tax rate, but rather than being marginal tax rate on the actual income, it's a marginal tax rate based on your super interest. So it's not like all of the income will get this additional tax. It's based on the share of your assets, the proportion that your income is deemed to be applied to. So if you've got less than 3 million, you're not having any tax. If you've got a balance of $5 million, only $2 million will be exposed to the 15% tax. That first $3 million will not pay tax on the earnings. So you're only going to be paying for the portion that's above 3 million. Should you? Yeah, sorry.
Oh, sorry, Sarah. I was just going to say. So if you've got, and I know you go through this example in a little bit, but if you've got $4 million in one member's fund, so it's $1 million over the three, and the fund earns 200,000 in earnings, so it's the rate or the tax would be levied. There'd be a 25% proportion against the 200,000, and that would be by the 15%, for example. I know you go through that in a bit, but I just wanted to outline that.
Yeah, and I think that's a key. I think it's a really key point to bring home is that this additional tax is not on the whole earnings. It's just on the portion.
It's a proportional tax.
Yeah. So those who have more than 10 million in their super fund, it's not going to be 25% against the whole lot. It's just going to be that portion above $10 million. So going to go to the example because I think it's good to just actually see in real numbers what this looks like. So we've got Jane. She's actually retired in pension phase and her total super balance is $4 million. What's important to understand is Jane actually is in pension phase. So she does get some benefit of tax-free income within her fund. So of that is 1.8 million. And then the accumulation is 2.2 million. Now we are most commonly going to see people who are affected by the new Div 296, so balances more than 3 million, will most likely sit in this position where they've got a part of their fund in pension phase and they've maximised what can go in pension, so they also have an accumulation account. And this is where Jane's at. Jane's super is largely made up of a commercial property, and it has a value of 3.5 million, and the rest of her super is made up in cash, so a term deposit. Jane is entered retirement with the intention of all that money in her super is going to actually go to her and she's going to take it out each year. So she's keeping the capital in her super fund and she's drawing out the earnings each year. What's important, and this comes in later, is just to bear in mind is that property that's valued at 3.5 million originally cost $2 million to the fund. So what we're going to start off with Jane in year one. Her total super balance is $4 million. Sorry, her balance is originally $4 million. And this is the first year of the Div 296. So the balance is based on 30 June 2027. Jane has $1 million above the cap. So we go 4 million less 3 million. So that is 25% of her interest is going to be exposed to the Div 296 tax. Now we know her earnings are 220,000, of which 25% will get taxed at 15%. So for Jane, she'll be seeing an additional tax of $8,250. So that tax to her will be assessed to her, not to the fund. So the question is, how is that tax paid? So Jane's going to receive an assessment from the tax office that says you've now got Div 296 tax. It goes against her personal income tax account, and she will have two options. She can pay it personally, or she can actually instruct that that be paid to a super fund. So she can do an election either via MyGov, or she can ask her tax agent who can go in and make that election for her. Then what happens is a message will go to the super fund. So she'll just determine which fund pays it, and it will release the funds. If you are under age 60 or you do not have access to your super and you use the funds out of the super fund without making the election, that's actually access to super that you're not entitled to. So that election must be made prior to the money coming out, because the ATO will then issue a notice to the super fund and it will tell the super fund to pay that out. So it's very critical. We make that assessment first, that election first. So we've got an understanding on how this Div 296 works. It's really important to understand the layers, because what we're looking at, if we're making a determination of where we're holding our investments, we need to know the full landscape. What tax am I actually paying within the fund? So we're looking at three types of tax. We've now got the pension phase. So anything that supports an account-based pension, we don't pay tax on earnings. The accumulation phase, it can pay 15% and then 10% on realised capital gains. And now we've got this Div 296, which goes across it, I guess, in one sense. So let's get Jane and the two, sorry.
So Sarah, maybe just go back a slide.
Mm-hmm.
Please.
Oh, this one?
Yeah. So I guess my understanding is, because we've got a lot of clients that have, they're both in pension phase and accumulation phase because of the transfer balance cap or the pension caps that came in a while ago. So I guess that sort of sits to the side and doesn't get touched. So how that's been operating keeps operating in the same way. And then going back to that example you had with Jane, where it was total fund earnings of that 220,000. She had $1 million above the 3 million cap, and so that then rolled on. I know you come up with this example next, but that then rolled on. Is that correct?
Yeah, that's correct. So we've got we're looking at the multiple layers of tax being paid.
Yeah.
So we're coming back to Jane now. So we already knew that she's got the 8,250 of Div 296 tax, which is apportioned to 25% of her fund. She also has a pension of 1.8 million and her accumulation balance of 2.2. So the split there is 45% pension and 55% accumulation. Earnings attributable to the pension account, we're not paying any tax on. So for Jane, before this Div 296 existed, she would have been paying 55% of her earnings would have been paying tax at 15%. So the net earnings of 220 with 55% accumulation phase, the self-managed super fund was paying tax of $18,150. So if we're looking at Jane and we're going, okay, I've got $220,000 of income that I've generated, she is paying a combined tax of $26,400. So what she pays personally and what she pays in the fund for holding those assets within the super environment. That would be the tax that she'll be paying. So when we do the maths and looking at moving assets out, remember that we're sort of cutting down what is exposed to any of our taxes. So that's the kind of assessment, and that's why it takes a bit more detailed approach before we start looking at what should come out. It's going to go long term, looking at how the tax plays out for them. So I guess the key thing is going, are we better off moving assets outside of super? Can we move assets outside of super? So it's really important to compare the tax environments. For some people, it actually will make sense. So they may not be utilising the tax-free space of their marginal tax rate. So maybe moving some assets out will be better off for them. Whereas if you're on a 30% tax rate already, once we start bringing assets out, we're actually creeping that marginal tax rate up because your personal tax rates are based on income. That's your marginal tax rate. The super fund is based on balance. So it's a very different calculation. There definitely are other such structures to consider, and things that could be considered are family trust companies and what their tax rates look like. But do they offer the same protection that you need for these assets? So these are the kind of things that we look at. So future growth expectations, liquidity needs, is it going to work moving things out? The asset protection, estate planning, how it works in with your estate, what taxes are we exposed to by leaving it where it is, and definitely the timing of asset disposals. So it might be a case of, look, we don't want to act now, but maybe in the mid-future, we do want to act. So this is where we come to equalisation strategies. Now, these have been around for some time, and I've always been a fan of them. Since caps have been introduced, it has always made sense to be looking at equalising balances between spouses. So here's some things that we can look at. The most common one talked about is the contribution strategy. Now, this can only be done when you have access to your super. So if you're under age 60 or 65, depending on your ability to access it, you may not be able to take money out of super. So you may be left in a situation where you just have to cop the Div 296. But if you have access to your super, it may make sense to do some withdrawals out of super and then putting it back in to a spouse who has a lower balance, which means we can shift some of the earnings and utilise the 3 million cap of multiple members. Now, that only works if the receiving spouse is eligible to receive contributions. So it's not a case of let's put money out and put it back in to our spouse. We need to assess whether or not this is going to work. It may be time, and there may be points where people start looking at, well, do we start shifting assets to adult children? Remember, a self-managed super fund can have up to 6 members. This does create its own concerns and things that you need to consider, and it really needs to be looked at in more detail with appropriate advice. But what the recontribution strategy does, it does give us better tax efficiency. It's going to reduce our exposure to Div 296, and it's also going to create more tax-free assets within the fund for estate planning. Now, this one's the long game, and this is probably for our younger members where typically, if we have a high income earner and a lower income earner, we see a real shift in their super interests over time. So I look at this as the long game, because what they can do is actually get their concessional contributions, which they receive from the employer or from their own personal concessional contributions, and they can the following year elect to have them go into the super fund of their spouse. Now, what that does, it just slows the growth in their fund, because instead of having those super contributions in their balance and accumulating year after year and the growth on them, they're giving that over to their spouse. So this strategy is I'd say the long game, but it actually can be quite effective over time. And it's not just for Div 296 purposes. There's so many other times where caps come in. So what we can have in a tax-free income stream, can the spouse access their super earlier? There are some real benefits in shifting contributions over to the spouse. Again, this all comes down to eligibility to do this. Okay, going on to property, because this is what we see a lot of, property held in self-managed super funds. And there've always been so many benefits of it because of the tax benefits we get, the CGT concessions, particularly if we move into pension phase. So it's a strategy that we really have seen used over the long time, particularly where we have commercial property, which complements the business. The problem with property and super, obviously, it's a clunky asset. So if we were looking at strategies where we could get ourselves under, it may not make sense because it's too high a portion of the fund, and the tax benefits for the most probably make sense to keep it in. The thing with your property is that the valuation spikes can trigger Div 296, because we do have over time seen higher increase in the market value. But having said that, other investments do the same. I guess it's that clunkiness of the asset that makes it a bit more, adds that extra challenge to it. So now we're going to come back to Jane. So Jane has had that commercial property in her fund. And let's see how it plays out when she actually sells a commercial property. So at this point, we've had it in the fund for some time. Their total super balance now is 4.5 million because the property has increased in value. It's now valued at $4 million. Now, remember when we originally started Jane's scenario, that property at 30 June 26 was valued at 3.5 million. So this is going to play out in what that Div 296 tax looks like. So Jane sells the property. Remember, we've got two taxes. We've got our income tax and then the Div 296 tax. So she sells the property and has a $2 million gain. Her fund, we know, has a pension phase of 45%. So she's only going to pay capital gains tax on 55% of that fund. So for the accumulation mode, there'll be $110,000 that she pays tax on for a $2 million gain. So this is just in isolation before we look at Div 296. Now let's look at the Div 296 impact. So Jane's total super balance is 1.5 million. So above the cap. So she now has 33% of her fund that's subject to Div 296. So originally she was only 25%, but as the fund has grown, the property's increased in value, that's now 33%. Given the property was valued at 3.5 million at 30 June 2026, and Jane was quite astute and made the decision to reset the cost base, she is only paying Div 296 tax on that $50,000 gain, not on the full $2 million. So to Jane, she will have a Div 296 tax of $16,667 for using the reset. Now, if Jane did not elect to have the reset, it would be $66,000. So there's a big chunk of difference from having that reset because that's paying tax on the whole gain of that property, opposed to the market value at 30 June 26.
So Sarah, with the CGT reset, that's something that we should be looking at with clients. It's my understanding is you can reset all your assets or none of your assets for Division 296 purposes.
Yeah, that's correct. It's all in or all out. So unlike the last time we had some grandfathering where we could cherry pick assets, at this point it's effectively everything. You either do it across your whole assets or you don't.
Yeah, and that's something we would do case by case with our clients. It's not sort of a one size fits all, is it?
No, it's definitely not a one size fits all. And you don't even have to be impacted by Div 296. So there could be some clients who are not there, don't think they're going to be impacted, but we might still look and going, you know what, there could be some benefits which you just don't know. So it's especially
in the case you've got a husband and wife and they've got, 1.2 or $1.5 million each, might be an opportunity to do a reset, if one of them does die and one balance goes to the other, etc. It could become valuable then.
Yeah, so it's one of those things where we go, this doesn't affect me. It might not affect you now, but you know what? It may affect you in the future. So this is something that we should be looking at for all of our clients regardless. Okay, so we consider why we still look at property. I think property still plays an important part in the self-managed super. It's just this 296 does add that extra layer. But I think some of the things we look at is the asset protection, how it works with the business. It's the tax effectiveness over time for it. The next thing is estate planning, and I think this one's really important because this is the one that kind of is a bit of a sleeper in how Div 296 works. Because the Div 296 is calculated at the date of the death of the member, and the liability will sit with the estate. So a concern that we can have is that if the benefits are paid out directly to beneficiaries, you could have an estate that effectively has a 296 tax debt that was not intended to be for that the remaining beneficiaries. So we really need to give some thought over what we do on that Div 296 and whether that needs to be factored into any estate planning. Big one that's coming out is reversionary pensions, which reversionary pensions have been really important in our pension space because it has allowed a 12-month benefit to the surviving spouse. It also takes away some of the concerns of having to act as quickly when a member passes away. We now need to consider what 296 has.
Yeah.
So the final total super balance calculation applies. So it is based on the hire of 1 July or the date of death. So we look at what the balance of the member is at that point. The income is just a portion for that period. So after their death, nothing counts against their total super balance. It's not actually allocated to a member. When it does get allocated to a member, if it's a reversionary pension, because a reversionary pension is assessed automatically to the surviving spouse, who gets a 12-month transfer balance cap free period, but it does automatically go to them at that value.
So Sarah, it's not uncommon our clients having mixed marriages where their super via a death benefit nomination form may be going one way, and then the estate is set up to perhaps not include those people who are receiving benefits from super. So it's a really important estate planning consideration that you could have someone receiving all your super benefits that has nothing to do with the estate, or vice versa, and then the estate having the Division 296 tax. That's a pretty big consideration, isn't it?
Yeah, it's a huge one, because a lot of the time, particularly with your second marriages, we'll see the super go to the spouse who gets it tax-free, and adult children are paid through the estate, through the will. So they will now be likely to be the beneficiaries who would be having to pay that Div 296. So we're going to actually have a look at Jane, what happens here. So sadly, she passes away, and she passes away on 31st of March 2030. At that point, her total super balance is 4.5 million, of which there was an account-based pension of 2.025 million. So we still got that 45-55 split for her balance. The Div 296 to the estate is based on the higher balance at 1 July or 31st of March, which is the date she passed. The earnings attributable are only for that portion from 1 July to 31st of March. So with her 220,000 income, only 165,000 will be subject to the Div 296 tax. So looking through her estate, she'll have that 165 at 33%, which is what's over the 3 million. So she's got 4.5 million. $3 million, we're not paying any Div 296 tax. So 1.5 being 33%. And then we've got the 15% tax that applies. So the estate will then have a tax bill of $8,250. In addition, Jane has also nominated her husband, John, as the reversionary beneficiary. So at this point, John has an existing account-based pension of 2.275. So what's interesting to look at John is that he's never actually had to pay Div 296. He's been below $3 million, so has not been impacted by this. However, once Jane's pension reverts over to John, it automatically goes against his balance. Now, we only ever look at total super balance at the start of the year and the end of the year. So even though John's balance is 4.3 million now, if he doesn't act in the next 3 months and does nothing, he'll be looking at having $4.3 million as his total super balance at 30 June that year. This means that John is now suddenly exposed to Div 296 tax. So if we're looking at what does John have over $3 million, he's now got 30% of his super is over $3 million. Therefore, he's going to pay Div 296 on 30% of his super earnings. It doesn't just go to 31st of March. It doesn't go proportionally. It will look at what his earnings were for the full year attributable to super, and he will be paying 30%. So 30% of that income will be subject to the Div 296 tax at 15%. Now, Jane also had an accumulation interest, and that also needs to be dealt with in the fund. However, she passed away at 31st of March, and typically there's a 6 months grace in how we do it. That gives us a chance to get all the affairs in order. So at 30 June, that money still hasn't been paid out. So that accumulation interest is still sitting in the super fund. It is not against a member, so no one has that interest at that point. Therefore, it is not subject to Div 296. So had Jane's pension not been reversionary, and we were still in that situation where it wasn't allocated to anyone, at 30th of June, none of her super interest would have been subject to Div 296 on to the beneficiaries. It would be for her at 31st of March. She would still have that assessment, but the balance doesn't get counted against anyone else at 30 June that year. So John would not have a Div 296 because the only asset he has in super at that point will be his original 2.125 that he had in super. So what that leads us to go in conclusion is really looking at what do we need to do. We've got 2 dates that we need to be really aware of. We've got 30 June 26 and we've got 30 June 2027. We know in this first year that 30 June 2027 is the period where we can get our balance, we can review our assets, look at the value of our assets in the fund, look where we're holding things. Do we have opportunity to move anything else? Should we be considering any equalisation strategies? Can we consider any equalisation strategies? And the 2 big things to look at is CGT reset. Is this something we want to do for your fund? And also looking at the pension structures. It may not make sense to change your pensions from reversionary or non-reversionary, but in some cases it might. So this is the time where we can really look at it.
So, Sarah, what are the key dates? Just with that, just going back for a sec, with that, the reset of the cost basis. Does that need to be done by 30 June, or is there a second bite of that cherry post 30 June?
Okay, so how it works, it's basically the value of your assets at 30 June. We believe it will be an election as part of the 2026 tax return. So at this point, we're sort of, the legislation is still pretty fresh. We haven't had the ATO come in and tell us how we're going to do these things. This is really an awareness session today because the detail still needs to come out.
Yeah, that makes sense with previous things we've had similar to this, where we get to make that election by the tax return due date, which typically for most is 15th of May 2027.
Yeah, that certainly gives rise to looking at particularly your assets such as property or unlisted shares, things that don't have easily accessible market value. You really need to consider getting them up to date because those valuations can have a long-term impact on what tax you pay in selling those assets.
Yeah, that's a good point. So if you are going to reset it at 30 June, which you might not be needing to physically do that in a tax return until either later this calendar year or early next year before the return's due, we need to rely on that balance, I guess, the value of the asset at 30 June 26. So yes, certainly an opportunity to have those assets, and especially the assets that aren't valued easily, such as market listed securities, to have those properties, etc., valued at 30 June 26.
Okay, so these are the things really, is to understand your super balance. So understand what makes it up. For the majority of people, they only have one super interest, so it's pretty easy to know what your super balance is. Identify your exposure to the threshold. So we've got 2 thresholds. We've got the $3 million cap and the $10 million cap. Look at your investments. Is it worthwhile moving, if you can, some of your investments? Always good to look at your overall wealth. Where are we holding things? So it may not even be as simple as moving money out. It might be going, I'm going to reduce the exposure to this particular asset and have that in this other holding. So really looking at your whole wealth and where things are sitting for tax purposes. Your transaction timing. So if we are moving things, when are we going to move things? What's going to be involved in moving things? What costs are we looking at to move assets? And probably what really ties us up is seeking strategic advice. So if you are impacted, let's sit down and assess not just your super fund, but your overall wealth and how it can work. So, final thoughts, looking at it, it doesn't remove the benefits of super, it's just reducing some of the benefits that do exist.
Okay, thanks very much, Sarah. It must have been a fantastic presentation, because thus far, and I do keep my mind keeps going back to the JobKeeper days, where we had many webinars and many questions coming up as we were going. We had questions popping at us every few seconds. So at the moment, we don't have any questions in the chat. So if you'd like to post a question, Sarah and I are available now. We can certainly answer it while everyone's on. So you can see at the top there, there's a Q&A button. If you press that, you can then type in a question. So Sarah and I are happy to answer any questions that you think may be suitable for the wider audience. And of course, we can also take questions after the event. There you go. No, it must have been. It must have covered most things well, Sarah. Probably one of the main things out of this. I wanted to have this as an awareness. Be able to show how the tax calculations indeed work, and but we suggest at this stage no action in terms of don't go and suddenly draw out half of your super or anything. Let's discuss any actions prior to taking action, I guess. Yep.
Thanks, everyone.
Yeah, as we stated at the start, we'll have this recording available. So if you'd like to email your accountant, myself, Sarah, I believe there's a few of Matt Dunn's clients on here and Rob Dayton's clients. So if you'd like to email your account, we can certainly send through the link. I believe the system may send a link out automatically, but yeah, we're happy to send the link, and you can relive the fantastic presentation that Sarah's delivered. So, all right, thanks very much, Sarah and everyone, and thanks for joining. Really appreciate it.